All right, so Bank of Canada has another rate cut this morning, 0.25%, and this was pretty much expected by the market. But every economist, every mainstream media was pretty much expecting this will happen, and the market was pricing in already. So there was no surprise per se. Okay, so what's going to happen is it's going to impact the variable interest rate mortgages pretty much straight away. But the fixed rate mortgages are not going to be impacted by this decision, although it will have influence on that as well. Okay, so just to understand, the fixed rate mortgages are actually influenced by the bond market. When you look at the 5-year Canadian bond yield, which is also tanking, by the way, it's 3.2% yielding right now. If you look at the trend, it's going down, which is going to influence the fixed rate mortgages going forward. Okay, so we will see there will be a reduction in the fixed rate mortgages in the coming days or weeks if the bond yields also stay at that level. If it spikes up for any economic shock, then of course this will reverse the decision by the fixed rate mortgage lenders. So what's going to happen? So basically, I have been telling you guys that the economy is struggling. Okay, they are now seeing that the economy is struggling big time. It's contracting big time. The real GDP per capita is already negative. Okay, and in that sense, we are importing a lot of people. The population is growing. The working age population is growing, but we don't have enough jobs to keep them occupied. Okay, so that is the big reason why the real GDP is negative, and why the central bank is looking at trying to kind of somehow put their S together to basically stimulate the economy. So that's the one reason why the interest rate is cutting, because they're seeing what's coming. Okay, Macro Alf is one of the best macro guy on Twitter. If you don't follow him, go and take a look at it. He put out a very interesting thread on X, or formerly known as Twitter. And he highlighted very, very basic points that the Canadian economy is struggling big time. Why? Because it has one of the highest private debt in the world. Okay, so when you have the highest level of private sector debt combined with high corporate debt and floating rate mortgages, you will struggle when the rate goes up. Okay, definitely, that's a given thing. And if you look at how the IMF is looking at, so IMF put out this chart comparing Canada amongst other countries in terms of the exposure of mortgage defaults, and Canada is on top. The Canadian mortgages have the highest risk of default in the world, followed by Australia, Norway, and Sweden. And given we still have a lot of fixed mortgages that are going to be renewed in the next 2 years, if the rates remain elevated, we will see a lot of mortgage defaults coming to the surface. Okay, so we haven't seen the damage yet, to be honest. And if you understand, or if you want to understand the level of private debt, you should compare ourselves with Japan. So in 90s, Japan has the biggest bubble, right, in the world. And at that time, the private sector debt percentage of GDP in Japan was lower than what we have today in Canada. So this chart actually compares the private sector debt as a percentage of GDP, comparing between Japan and Canada. And you can see that we are way above what Japan used to have in 90s. Okay? And just to give you the context, the Imperial Palace in Japan back in 90s was valued more than the entire Californian real estate. Okay, think about that. That was the peak of the bubble in Japan, and they haven't recovered yet, even after 40 years. Okay, so this should be frightening you if you haven't paid attention. So OECD also compared Canada's progress. Okay, this is basically comparing what Canada used to be in 1980s, how we fell down in 2021, and how we are projected to fall down by 2060. Okay, this is all about comparing the GDP per capita. Again, GDP is misleading. GDP per capita is a true way of measuring growth because you're adding a lot of people in the population. So you must look at per capita GDP contribution, which is tanking and negative right now for various consecutive quarters. And I was reading the monetary policy report, and one of the chart that Bank of Canada themselves put out was very, very concerning. Look at this chart. So basically, this is comparing the people, working age people in Canada, are struggling to find jobs. Okay, so the red is Canadian born, blue long term immigrants that have been here for more than 5 years, and the newcomers are actually coming in the last 5 years, and they are the one going to struggle to find employment in Canada, okay, as per their own survey. This is what Bank of Canada is telling you guys. So a lot of immigrants, if you're watching this channel, brothers and sisters, hold tight. Things are going to get worse. And if you don't have a backup plan, you should start thinking about it, because the rate cuts is not going to save the economic disaster that we are facing right now. Okay, just look at the Loonie, look at the Canadian dollar chart against USD. You can see it's tanking like a rock. Okay, and I've been telling on this channel that one of the biggest outcomes of this rate cutting cycle is basically Canadian dollar is going to tank against USD, because the US dollars, the Federal Reserve hasn't cut rate, and we are reducing rates. So the differential between US and Canada in terms of the rate is going to be bigger, which is going to tank Canadian dollar. And the only thing that can save Canadian dollar right now is the higher oil prices. And guess what? Oil prices are also sliding down. Okay, so they went up in 2024, at the beginning of 2024, but now since then it has been coming down, which is also not helping to provide a floor for the Canadian dollar. So while our mortgages are getting cheaper, but our Canadian dollar is tanking, which is going to make pretty much everything expensive that we buy in our lives. Okay, so we are screwed anyway, guys. Okay, the Canadian dollar is our purchasing power. That is tanking. Doesn't matter if the rate cuts going to come and reduce our mortgages. We are screwed from our purchasing power anyway. Let me know what you think about that. Put your comments down below, because I want to hear from your perspective as well. How are you going to protect your purchasing power? What is your investment strategy? What is your next 5-year plan in terms of protecting yourself from an economic disaster and the inflationary bust that is coming our way through this currency depreciation? Anyway, if you like this video, give me a thumbs up, subscribe, and I'll see you in my next video. Take care. If you are an investor in the US, in Canada, or in Europe, and you are considering investing into Dubai real estate market, this video is for you, because we have a platform called Stake, which allows you to invest into the residential real estate market and start earning rental income right away without going through a lengthy documentation process or coming up with a heavy down payment. Stake is built upon the concept of crowdfunding. So it is democratizing the entire investment strategy and allows you to own a single unit of the entire investment portfolio. So you don't have to own the entire property, right? You can be part of the pool that can actually own a piece of property, a piece of real estate. So that allows you to start with as low as 2,000 dirhams, and you can slowly ramp up. So as you start investing into it, you can not only own a bit of real estate, but you also get a portion of the rental income on monthly basis. So it's a passive investment strategy, diversifying your portfolio from traditional North American or European markets into Dubai, which is hustling and bustling and growing very fast, and allows you to build your wealth over time. So don't delay. There is a link down there in the description. If you click on this, it will give you free 200 dirhams in your account right away to start with, and you can thank me later.